welcome. You're watching Business Today Television. I'm Sakshi Batra and this is BTS, that's Behind the Scenes, a show where we showcase a sneak peek into the latest edition of the Business Today magazine with all our viewers. Joining in on this special edition with me are my colleagues Krishna Gopalan, Executive Editor of the magazine. We also have Surabhi, the Economy Editor, and Richa Sharma, the Senior Assistant Editor of Business Today magazine, all with us who've been contributing greatly to this newest edition. And now to showcase the glimpse of this latest edition. I already have the copy in my hand, so you can actually look at it. It's a face-off, and the face-off is with respect to Religare. So you do see Rashmi Saluja, the Executive Chairperson, Religare Enterprises on the cover, and you also have Mohit Bharman, the Chairman of Dabur India. Now, as we all know, there is the Burman family has been now locked in a bitter feud for control of the 6,300 crore rupees Religare Enterprises, with the present management and in particular Rashmi Saluja right in the center of the controversy and this corporate pot boiler that we are seeing. Krishna has been tracking this story for us and for all our viewers. So Krishna, let me start off with you. Help us and help all our viewers really understand what exactly is happening with Religare and what is the story and this feud all about?
Hi Sakshi, good to be here. This goes back in time. Religare basically was founded by the two Singh brothers, Malvinder and Shivinder. As all of us know, they got into a serious issue because they were alleged to have diverted funds from the Finvest business. There was a change in management that took place, and Rashmi Saluja subsequently came on board as a director and then got promoted to become the executive chairperson. This is around 2019. The primary job of the company was to clean up the balance sheet. They finally had a debt restructuring with the banks, followed by one-time settlement. That whole amount ran to about 9,000 crores. So it seemed as if it was back to business. The worry was the moment the Singh brothers divested a shareholding, most of the debt that they owed to the banks got converted to equity. As a consequence, Religare had a complete dispersed shareholding, making it very easy for a potential acquirer to come into the market and buy shares. This is exactly what the Burman family did starting 2018, so it's been about 6 years now, where they picked up bits and pieces of the company. Now Religare has 4 businesses, and the crown jewel is the insurance business. I'll just come to that in a minute. The fundamental strategy of the Burman family was to make sure that they picked up stakes at various intervals. The Burman family themselves are no strangers to the financial services business. They are the people who actually put together ABN AMRO equities. They had a stake in Fidelity Mutual Fund. They also hold shares in a couple of insurance companies as we speak. So financial services, given where it's placed today, became a strategic fit for the Burman family to the family office, I must clarify. So this is the same family that also promotes Dabur, the big ticket FMCG company. Through a process of acquiring stake for about 6 years, they finally hit the mark of 25%, making the 26% mandatory offer. This is when the whole issue ran into a bit of a problem, because Religare management now started resisting the whole thing on the grounds that the Burman family was not fit and proper to take over the company. So the issue basically reached a deadlock, and that's exactly where we are placed, a situation where the rule book is absolutely clear about having to pick up to 26%, but the incumbent management saying that the Burman family was not fit and proper to buy over the company.
Right. But again, the question will be what exactly is the definition of fit and proper in this case? And of course, do tell us about the latest twist with respect to the SEBI order and a show cause notice that has been now issued as well. What happens now?
The fit and proper part actually cuts across businesses because Religare is diversified. So it has to get the go-ahead from SEBI, the Reserve Bank of India, and also the insurance regulator, IRDAI. Now the definition of fit and proper varies depending on which regulator you're speaking to. But fundamentally, there should be no conflict of interest with an existing business, and the potential acquirer, Burmans in this case, should not be stuck in some kind of illegal activity or a kind of having a vested interest overseas. That's broadly the peg of the fit and proper part of it. It broadly appears as if that there shouldn't be much of a problem with that. They have to address the issue a little, they have to therefore address the issue. So the ball is completely in the court of the regulators now as the papers start to move. That's one part of it. Now there's a bit of a deadline as far as the SEBI order is concerned. The SEBI order came out in mid-June, making it absolutely clear that Religare's management had no business to procrastinate or defer the open offer. So the issues got stuck there. It is a very strongly worded order, and they said that if Religare did not find a reason to allow the Burmans to do it, there's no question of the open offer being resisted or desisted. very stern warning. So they had to file their response. Religare quite predictably moved the issue to the Securities Appellate Tribunal, the SAT. SAT made absolutely clear there could be a stay as far as the specific contents of the SEBI order are concerned, but there's no negotiation in terms of going into the open offer. So that's where the issue stands. From what we gather, it appears to be a question of time before Religare moves the papers on the open offer with the Reserve Bank of India, followed by other regulators.
But do tell me, for all the viewers also listening, how important is it for Religare, for the Burmans to actually look at Religare as a potential acquisition? Will they really benefit from this acquisition if this were to go through?
Sakshi, it has four businesses. There's broking, there's NBFC lending, there's a housing finance arm, and finally there's Care Health Insurance. The jewel in the crown is Care Health Insurance. It's a standalone health insurance company. Kedara Capital is putting cash there. It's a very well-run business. They also see potential in the fact that the other businesses suffered because of capital not having come in. We spoke to analysts and we've also quoted the people in the story to say once the money comes into the other three businesses, the company is set to fly. And as I said earlier, it makes a strategic fit with the existing businesses of the Burman family. And financial services, given where we are placed today, be it NBFC lending or housing finance or insurance, there's sufficient headroom for growth. It is very clear that this is the opportunity the Burman family has spotted in the business.
But how difficult is it going to be to get to the final point? Is it going to take a long haul, a lot of back and forth happening? How do you assess the situation currently as it is?
Sakshi, the battle is anything but over because it's obvious the current management of Religare will not give up the company in a hurry. Look at it this way. When they took charge, the stock was trading at 17 rupees. It's about 240 today. So the potential loss of control is obviously not going down well with the current management. So they will do anything to make sure that the management control remains with them. So if it means moving the case to Supreme Court, that's a possible option. But the way I see it, I think it's going to be a good 4 to 5 months before any kind of tangible conclusion emerges.
All right. Well, Krishna, please keep an eye out on this whole space. I'm sure this has a lot of next twists and turns for all of our viewers to really continue to tap on, and we'll continue to come back to you for all the developments on that front as well. But let's now understand more. What else can you really look forward to when it comes to this special edition? Remember, we've just had the union budget, and this time around, if all of you viewers are used to watching the budget speech and noting down the key numbers, there's one space that was absolutely not mentioned, and that is the disinvestment part. And Surabhi is here with us to really help us understand why this entire space was the missing link and what happens next on this front as well. Surabhi, do tell us, in the last few years, we've actually seen the government really faltering on meeting their disinvestment targets. Even when they float around, the demand is not there as much from the private players as well. Explain to us, how have the stake sales of public listed companies really panned out in the last few years, and why was this factor really missing in both the interim as well as the union budget?
Thank you, Sakshi. Lovely being on this show. So, like you pointed out, in the past few years, stake sales have not really been happening in public sector enterprises, and I think Air India was one of the last big strategic stake sales which we saw. Yes, so everyone's been waiting on action on that front. But over the last few years, the strategy of the government has slowly changed, and rather than just selling, companies left, right, and center, they want to go for a more calibrated approach. And this is something which they want to continue going forward also in this fiscal as well. And despite concerns of a coalition politics and how it would impact the disinvestment program, both the finance minister as well as the Deepan secretary, they've been clear that the current strategy will continue. And the finance minister, in fact, in the post-budget press conference, had also underlined that all cabinet decisions that have taken so far on disinvestment would be honored, but the timing, of course, is something which the government will have to decide on. So even in the past, we've had cases where we've had like small stake sales and OFS kind of things, and then dividends from PSUs has been a huge source of revenue. In fact, this year, the government's looking at a combined dividend of about 1 lakh crore from both dividends from PSUs as well as stake sales, out of which 56,000 crores estimated to come from dividends. So the whole idea now is to nurture PSUs and make sure that they're performing well, so that there's value creation as well as value maximization when they go in for stake sales.
Right, so Surabhi, what can we expect on this front going forward from here now?
So going forward, while disinvestment did not feature in the union budget the term, and even when you go through the budget documents, you see that the word disinvestment does not appear anymore. It comes under the subheading of miscellaneous capital receipts. So the current strategy is going to continue, and like I said previously, ongoing transactions are likely to continue. So the big ticket transactions, whether it's the IDBI Bank stake sale which has been going on and the privatization, subsequent privatization, that exercise is still on. Shipping Corporation of India is of course another big exercise that's underway, and it's likely to be done in the coming months. Similarly, there are a number of about 10 PSUs still remain which have received approval from the cabinet for strategic disinvestment. So we need to see how these are taken forward. However, there's certain strategic sales such as that of Concord, which has been put on the, you know,
Yes, back
cold.
burner.
Yeah, that's been put on the back burner because the railway ministry is not very keen on it, according to sources. Similarly, in the case of BPCL, also the petroleum minister has already said that that's not going to happen. So these companies are, of course, off the table. But then we will also see small amounts of stake sales as and when needed, when depending on the timing. And but the potential is huge. A recent report by CareEdge Ratings had said that the government can raise as much as 11.5 lakh crore by selling stake in PSUs while retaining 51% control.
Okay, so we'll continue to keep an eye out on that to track the disinvestment picture going forward from here. But let's now come to Richa, who will detail for us what is the plan as far as the development of the road infrastructure is concerned. Remember, viewers, in the last 10 years, last decade, we've actually seen a sharp expansion, about 60% expansion in the national highways that were created. But within that, one trend was pretty clear, and that was the absence of the private investments. Now, Richa, help our viewers really understand, when it comes to road infrastructure, why has private capital remained absent and why does it still remain a challenge?
Thank you, Sakshi, for hosting me. One of the most interesting thing, even finance minister during the budget also spoke about that. They're still working at bringing the financial capital, the private capital, basically for the infrastructure. And if we look at the economic survey pointed out, if suppose 1 rupee is invested, so 80 paisa comes from the state and center, and only 20 paisa is from the private players. And this was not the case, especially in the highway sector. If we look at, so in 2012, the highway sector was investing heavily. Almost 96% of the investment in highway sector was happening from the private players. But in come 2019, and it dropped to almost zero. So the reason behind that was, increasing debts. What happened was land acquisition plays a very key role when it comes to the highway construction. So if the land acquisition is delayed, that adds to the debt, that adds to the timing. And then some of the highways that were constructed had traffic issues, the parallel roads came, and which impacted the toll collection. So some of the big companies like Gammon, HCC, they went in a huge debt trap. And that was the reason that majority of the private players decided not to go for, what we call as the build, operate and transfer model, where, total, the investment was from the private sector.
Right. So now, Richa, tell me, what is the government trying to do in terms of attracting these private players to the sector, and what does the current scenario look like? Are you going to be seeing a pickup in that space?
So government has been working, from last 1 or more so year. They've held several stakeholders meeting, understanding the concerns of the private players, that what is stopping them from coming into the highway sector, or let's say even the railway sector. So what they have done, based on the feedback, what they have done is they have amended the model concession agreement, where they have incorporated the concerns of the private players, which included that land acquisition. The government should ensure that once the if the project is given to them, so the land is acquired, even if they default, there has to be a payment which should happen to them. Thirdly, in case if the toll is less, they be given some compensation on the part of the toll. So these are the 3-4 major things which they have incorporated. And based on that, what we are seeing is that there has been a good interest among some big construction players who are really looking up to bidding for the projects, the private players. So the government has lined up let's say around rupees 2 lakh crores of private projects, highway projects in next couple of years, and for this year itself they have almost 55,000 crores of projects of 900 kilometers, and we are seeing really good interest. There are 4-5 big players who are bidding for it, and they're really upbeat about it.
All right, but are there going to be any further challenges that continue to exist which will need to be mitigated first?
Yeah, see, if you talk to the analyst or if you talk to the the people who research on the industry, and they think that private players need to be cautious, still need to be cautious, because it's still coming up. And it is smaller players. What we have seen is that there's another mode called hybrid annuity mode, where it's 40-60, 40 from government and 60 from private players, while 60 comes later as annuity mode. So there has been an aggressive bidding which has brought down the profits from 15-20% to 5-6%. So some of the big players have decided not to go for the for that HAM project and go for the private, total 100% private investments. So what they caution is not to go for aggressive bidding. Only big players, like the big fish in the market, should invest, because people who are here for short term profits would face losses. So it is, you're here, so you have to stay for longer, because it's 25 years of contract. And second is, again, there are still concerns related to land acquisition. Right. So they've been concerns, and they've asked government that they should ensure that clearances and land acquisition part should happen quicker for this mode, for private players to stay invested in the highway sector.
All right, Richa. Well, thank you so much for giving us that update. Krishna, Surabhi, Richa, all three of you, thank you so much for sharing all these wonderful insights with all our viewers. And viewers, to you, I can only say that you need to go out there and grab your copies. They've already hit the stands. This is something that you definitely need to add to your weekend read as well, going forward from here, because this is going to give you the entire insight about as to what's happening in the corporate world, what's happening post the budget in terms of development on ground as well. So everything that you need to know is right there. Stay tuned with us on Business Today Television. Lots more coming up on your screens.